Hello and welcome to this presentation on financial instruments. In this presentation, I would like to summarize the key aspects of financial instruments which are relevant to the Strategic Business Reporting exam. It is a technical area of the syllabus and one of those areas that candidates often struggle with. So let's see if we can bypass the terminology, think about what we're actually trying to communicate in the financial statements, and thus have a better approach to financial instruments in the exam. So there are a number of accounting standards that financial instruments influence, and we'll run through these, starting with IAS 32 that looks at presentation. Now, it's presentation of debt versus equity, and when we go to raise money, some of those instruments are recorded as debt and some of those instruments are recorded as equity. And a basic point, but an important point to keep in mind, is why does it matter whether something is recorded as debt or equity? Well, anytime we record an instrument as debt, it causes our gearing to increase. And generally speaking, where we have a higher level of gearing, we're said to carry a higher level of risk. And this impacts on the weighted average cost of capital of the business. It will go up. And thus, if we now face a higher weighted average cost of capital, we will have to undertake projects which generate a higher level of return. So ultimately, therefore, the classification of debt versus equity can impact on the strategy that the company is following. So I would be on the lookout for situations where the company is financing a new project, it's thinking about different forms of financing, and we're considering whether those instruments would be classified as debt or equity. Now, two common examples of that, of course, are preference shares and convertible debt. With preference shares, although the legal form of the instrument is that it is a share, the substance is often that it is debt, it is a liability. And that's because the company is under obligation to pay the preference dividend. Now, if the preference dividend is cumulative or the preference share itself is redeemable, that obligation exists and we record our preference share as debt. In basic double entry terms then, this is a debit to cash and a credit to liability. And of course, if we put that entry through the financial statements, we have more items being recorded as debt, and this is causing a gearing level to increase. Now, don't forget, the impact is that if we record this as debt, we are essentially treating the preference share as a loan. Now, normally, dividends go through retained earnings because they are transactions with the owners of the company. However, if we are treating the preference share as a loan, then the preference dividend won't be going through retained earnings. Instead, it will be going through the finance cost line in the income statement. And as well as gearing, banks will often monitor interest cover, which is the amount of times that an operating profit covers the interest charge. And of course, if the preference dividend is going through the finance cost line, your interest cover has just got worse. So where a preference share carries an obligation because either the preference dividend is cumulative or the preference share is redeemable, it will cause an increase in gearing through its classification as liability, and it will cause interest cover to be worse because the preference dividend is going straight through the finance cost line in the income statement. Now, a common instrument in this exam is convertible debt. This is quite simply a loan which could be converted into shares. And from an accounting point of view, we need to understand whether to classify this as debt because it is a loan, or shares because it is equity. And we've commented that debt versus equity is important because of its impact on gearing, risk, return, and thus ultimately strategy. So what we do is we split account the convertible debt into its two component parts. We're actually going to record some as debt and some as equity. And we'll do this in line with the conceptual framework definitions of debt and equity, and this should give us a more realistic understanding of the risk to which the entity is exposed. So imagine a £2 million loan which could be converted into shares. Imagine there is a 6% coupon rate on this loan. This means that the physical annual payments are £120,000 each year. So in terms of physical cash flows, we would have to pay 120,000 in year 1, year 2, and year 3, and at the end of year 3 we will repay the principal of 2 million. Now what we have to do is to take those physical cash flows and discount them back to their present value. Now the rate at which we will discount is the prevailing market rate of straight debt with no right of conversion. In other words, what we're trying to do is to treat this part of the instrument as if it were debt. So it makes sense to discount using whatever the market rate for debt is. So in this example I've chosen 9%, and we can see discount factors for time 1, time 2, time 3 at 9%, and assuming the principal is repaid at the end of time 3, there's our time 3 discount factor at 9%. Now we work out the present value of all of those cash flows, so that's the present value of the interest payments and the present value of the capital payments. This totals 1,848,122, and this would be set up as a liability. Now given that we've just received cash of 2 million, bear in mind we're using this convertible instrument to finance the business, we need to debit cash with 2 million, credit liability with 1,848,122, and that makes sense because the definition of debt is the obligation to transfer economic benefit, and we have measured our obligation to make interest payments and our obligation to repay the principal. The definition of equity is a residual interest of assets less liabilities. And with 2 million cash received, the amount that's left over, or the residual interest to give it its technical name, is 151,878, and thus we would credit equity with 151,878. Now again, what we need to be able to do is go beyond actually calculating this and actually comment on the implications of it. And if you finance with an instrument which is convertible, you can see you've added lots onto debt and only a little bit onto equity. So the impact of that is that it will cause your gearing to go up. And of course, if gearing goes up, we know that we have an increase in risk, and thus we need a higher level of return, and therefore this impacts on the strategy. So two simple instruments, preference shares, convertible debt, but we want to look at the impact of using these instruments for financing strategy within the business and the impact that these instruments have. So do make sure in preparation for the exam you're completely okay with the debits and credits, and particularly the calculation around the convertible debt, and my advice would be to learn just a little summary, which is debt versus equity. This impacts gearing. If gearing is high, risk is high. If risk is high, we need a higher return, and ultimately this impacts on the strategy of the organisation. On now to IFRS 9, which essentially deals with measurement. The standard itself has 3 areas to it, which is the measurement of assets and liabilities. There is also rules for hedge accounting, and there are also rules for impairment as well, and we'll look at each of these 3 aspects separately. So let's start with measurement. And the IFRS 9 approach to measurement is a strategic one. In other words, you have to identify the business models that the company follows. And there are 3 business models that we could have. We could have hold to collect, we could have hold to collect and trade, or we could have hold to trade. Now imagine a typical bank. Typical bank might have an investment section and it might have a retail section. The retail bank might typically just give mortgages to members of the public and collect in those contractual cash flows as they fall due. And so everything in that part of the business, everything in the retail banking division, would be classified as hold to collect. Whereas if you had an investment division, the investment division would be trading in financial instruments, and so everything in that division would be classified as held to trade. So let's just talk a little bit further about this business model approach. If I were to lend you money, say you wanted a mortgage, and I lent you money for 20 years at a rate of 4% per annum, and all I'm going to do for the 20 years is simply to collect in the contractual cash flows as they fall due. That's it. That's all I'm doing. I'm never going to trade your instrument. I'm never going to sell it. And so fair value is completely irrelevant. In which case, I am simply going to use amortized cost to measure the instrument. However, let's imagine that I've lent you the money at 4%, but someone else comes along and wants to borrow a similar sum of money, but they're prepared to pay me 6%. Now, I might be the sort of company that would sell my original investment and swap it for the more attractive alternative at 6%. So now I have a business model which is both hold to collect and hold to trade. If the more attractive alternative at 6% had not come along, I would have simply collected in the contractual cash flows for the 20 years, and that would be a hold to collect business model. However, because the more attractive alternative has come along at 6%, what I am going to do is I'm going to sell my original investment and swap it for the more attractive alternative. Now, given that we might be in a position, therefore, where we are trading this instrument, we ought to measure it at fair value. So we would still apply amortized cost, but at the end of the year, we would do a fair value adjustment. Now, I'm not actually trading this instrument, I only might be trading the instrument, and therefore the fair value movement will go through OCI. So that's a debit to financial asset, a credit to OCI. Essentially what we're doing is we're creating a revaluation reserve within equity for our financial instrument. Now, we've just seen where the hold to collect and hold to trade business model might exist in circumstances where we're always on the lookout for a more attractive alternative. However, it could also exist if, for example, the company were to run out of cash and for liquidity reasons, rather than actually simply collecting the contractual cash flows, it sells the original investment to free up some liquidity. So hold to collect and hold to trade model could exist in a number of different circumstances. Now back to the investment division where instruments are just simply being traded, and if that's the case, we ought to be measuring at fair value. Now all that happens here is that the fair value movements will go through the profit and loss account because we are actually trading in those instruments. And even if we haven't actually sold them at the end of the year, the intention is we will sell them shortly thereafter. So by putting the fair value movements through the profit and loss account, we are holding the directors directly accountable for their performance. So quite simply, debit financial asset, credit profit and loss. So what we see then is three measurements: amortized cost, fair value through OCI, and fair value through profit and loss. Now amortized cost is one area that people do get stuck on, and it's a very simple measurement. It's calculated by taking the original amount plus the interest less the cash. So when we originally invest in an asset, it's a debit to financial asset, a credit to cash. When we then earn interest at the effective rate, we debit financial asset and credit finance income. And when we receive cash, it's debit cash and credit financial asset. Now, a few points of detail to point out. If you are measuring something at amortized cost, the idea is that you are supposed to be spreading everything to do with the instruments over a period of time, the period of the instrument itself. So what we will do is we will include transaction costs as part of the initial investment. So an investment of 100,000 with 2,000 of transaction costs would mean that we would originally set up the financial asset for 102,000. When we then apply the effective interest to that 102,000, it's actually having the effect of spreading the transaction costs over the life of the instrument, rather than having those transaction costs hit the profit and loss account in the first year. Furthermore, don't forget that it is the effective interest which goes through the profit and loss account, whereas it is the coupon amount which goes through the cash flow statement. So the effective interest is adding up all the ways in which we can earn money from the instrument, and it is spreading those over the life of the instrument. Let me just give you a brief demonstration of that. Imagine that the instrument had a 10% coupon. So we basically make an investment of 100,000, we receive 10,000 in annual cash payments each year, and thus we also get our £100,000 back at the end. Now the only way in which we are earning money on this investment then is through the 10,000 annual coupon, and this gives us an effective interest rate of 10%. So in this particular example, the amount of interest going through the profit and loss account each year, 10,000, is equal to the amount which is going through the cash flow statement, because we are earning and we are receiving at exactly the same rate. But let's now imagine that in addition to earning money via the annual coupon, the instrument was also issued at a discount. For example, the investor wanted to invest £100,000. However, to make it look more attractive to the investor, they only had to give the investee £90,000 up front. So immediately what's happened is the investor has earned £10,000 because the instrument was issued at a discount. Now, in addition to that, they will also earn the annual 10,000 coupon rate per annum, and at the end, although they only originally gave out £90,000, they will receive back their £100,000. So we've earned money in two ways. We've earned money from the initial discount of £10,000, and we've earned money from the annual coupon of £10,000. Now, although one of these happens at the start, and one of these is being earned throughout the life of the instrument, we actually have to add up and calculate the effective rate. In other words, we have to spread or amortize the entire earnings of the instrument over the life. And you can see that this gives us an effective rate of 13%. Now, it could be that in addition to earning money at a discount, because a 100,000 instrument is issued for only 90,000, and earning money at a coupon rate, because a 100,000 investment pays an annual 10,000 of interest, perhaps the instrument also earns money because it is redeemed at a premium. So there is a premium on redemption. In other words, rather than getting back the £100,000, maybe we get back £105,000. So you can see in the last year of the instrument here that the 115,000 is the original investment of 100,000 plus the annual interest of 10,000 and the premium of 5,000. Now we're earning some from the discount, that happens right at the start. We're earning some from the coupon, which happens throughout the life of the instrument, and we are earning some from the premium on redemption, which happens right at the end. Now, just as we do with depreciation on property, plant and equipment, we ignore when these amounts actually occur and we just spread them over the life of the instrument. And so this works out as an effective rate of 14%. So we can see that if the coupon rate is the only way in which we are earning money on the instrument, then the amount going through the profit and loss account and the cash flow will be the same, because we are earning 10,000 per annum and we are receiving 10,000 per annum. However, if the instrument is issued at either a discount or a discount and a redemption, we can see that the annual coupon remains at 10,000. In other words, we're still receiving 10,000 per annum, but the effective interest rate will be higher than that because we are spreading the earnings from the discount and the premium over the life of the instrument. Now let's take a look at hedge accounting. And typically hedge accounting will involve derivatives. And there are three types of hedge accounting. There's a cash flow hedge, a fair value hedge, and a net investment in a foreign operation. Now, derivatives, of course, are betting on an underlying variable at a future point in time, and technically, therefore, all derivatives should be measured at fair value through profit and loss. So you can have derivatives in the business, forwards, futures, options, but you can choose not to apply hedge accounting. You can simply measure those derivatives at fair value through profit and loss. All that hedge accounting is essentially doing is playing around with the accounting period in which the movement on the derivative actually hits the financial statements. Before we take a closer look at that, let's just look at the criteria that need to be in place before hedge accounting can be applied. And there are three things to look out for. First of all, there must be an economic relationship. So, if your business problem causes a loss, we must see that there is a corresponding gain caused by the derivative, essentially an equal and opposite effect. We also want to make sure that the credit risk does not dominate. In other words, if I am concerned about the price of coffee and I have a derivative which is based on the price of coffee, then the movements on that derivative should be driven by the pricing of the underlying variable, rather than the credit rating of the party that actually issued the derivative. We also want to see that the hedge ratio is consistent with risk management strategy. Now, take a futures market. Derivatives on a futures market come in blocks. They come in standard sizes. So for example, I might be able to buy blocks of 10,000 coffee beans, for example. Now, if my business problem is 96,000 coffee beans, I've got to go out and purchase 96,000 tons worth of coffee beans, I have a problem because I can only get derivatives in blocks of 10,000. So of course there will be some ineffectiveness. And so I've got two choices. A 96,000 ton business acquisition of coffee beans could be hedged with either 90,000 of derivatives or 100,000 of derivatives. So we can see that the hedge ratio is not exact, and that's because the futures market deals in standard blocks. And what we're saying is that in order to apply hedge accounting, the amount of derivative we actually have should be consistent with what we do internally for management purposes. In other words, if I typically hedge 96,000 tons worth of coffee beans using 100,000 of derivatives, well, that's absolutely fine because that's consistent with my normal internal hedge ratio. So let's take a straightforward example of a cash flow hedge. We're concerned about a future sale. So let's imagine we're an entity who functions in sterling and we're making a sale into a European market. So we will be receiving revenues in euros. So of course, if the exchange rate changes, then we end up receiving less sterling. That's our business problem. So there's a highly probable forecast future sale, and we are going to try and hedge that transaction. Now let's imagine that as we go through the year, it turns out that the amount of revenue that actually we're going to receive has fallen by 10. The good news is we anticipated this might happen, and we took out a derivative that bet on the sterling-euro exchange rate. Now, in the same period of time, we see the gain on the derivative is in fact 11.6 million. And there's no guarantee that the gain on the derivative is exactly going to match the size of your business problem. And we talked about why that ineffectiveness might exist. For example, we might have futures contracts which come in standard blocks of sizes. Or the commodity that the derivative is betting on is ever so slightly different from the commodity that we are actually selling. But here we see a business problem of 10 because revenues are going to go down by 10, and we see a gain on the financial asset of 11.6. So in terms of double entry, we just debit financial asset with 11.6. The size of our business problem is 10. In other words, exchange rates now mean that we will receive 10 less sterling than we had originally expected. And that effective element is credited to OCI. In other words, it is pulled down into reserves. It doesn't go through the profit and loss account now. However, the last 1.6 of gain on the derivative does go through the income statement because it's not actually protecting against our business problem. Our business problem was 10. And thus the last 1.6 of gain on the financial asset is not actually achieving anything, and therefore it's credited immediately to the income statement. So in summary, we now have 10 sitting within a cash flow hedge reserve. What will we do with it? Well, we will hold it there until we actually make our sales that we were concerned about. And when we do make those sales in a year's time, there was an original expectation of sales, let's say, being 100. And with a cost of sales figure of, say, 70, this would give us an expected profit of 30. But because the exchange rate has moved over the year, the actual revenue, the actual sterling that we receive is 90. Cost of sales remains at 70, and thus our reported profit is only 20, which is 10 less than what we told the shareholder it was going to be. So the good news is that we anticipated this. We have 10 saved up in reserves. And so now what we do is we take that 10 out of reserves and we basically release it into the income statement. And thus, with an extra 10 being credited to the income statement, that takes us up to a profit of 30, which is in line with the original expectation, and thus we have avoided the volatility that shareholders do not like. So all a cash flow does is to essentially take the movement on the effective element of the derivative, defer it down into reserves, carry it forward, and release it to the income statement in the year when the business problem actually happens. So how does a fair value hedge differ from a cash flow hedge? Well, if a cash flow hedge is concerned about a future, then the fair value hedge is concerned about something which is happening now. In other words, our business problem is already recognized in the financial statements. For example, we could be concerned about fluctuations in the valuation of inventory. Now, let's imagine that we typically had barrels of oil and we were concerned about fluctuations in the value of the inventory of oil. We may take out a derivative to protect against those fluctuations. And as we know, all derivatives have to be measured at fair value through profit and loss. So let's imagine that in the year we see a loss on the derivative. So this would involve a debit to the income statement and a credit to financial liability because the derivative is standing at a loss on the balance sheet. However, there's an accounting problem here because although we see a debit to the income statement quite correctly in respect to the derivative, we can't actually see what that derivative was hedging against. And that's because inventory is normally held at cost. We don't normally remeasure inventory to its fair value. So where we apply fair value hedge accounting, as well as measuring the movement on the derivative through the profit and loss account, we take our recognized asset, in this case inventory, and we remeasure it to fair value. And so let's imagine that the price of inventory had gone up. So we would debit financial asset and we would credit income statement. And now we can see that the credit to the income statement in respect to the inventory would offset against the debit to the income statement in respect of the derivative. And thus we have prevented the volatility from occurring. Now, as well as fair value hedge accounting applying to items already recognized in the financial statements, you might see the phrase firm commitment. Now, what is a firm commitment? A firm commitment is something which is legally binding. So, for example, if you were actually going to go and buy an aircraft in a year's time, you would have to sign a contract to do this, and thus you are now under legal obligation to purchase. Now notice therefore the difference between a firm commitment which is legally binding versus a highly probable future forecast transaction. A highly probable future forecast transaction may still not occur, but a firm commitment has to occur. So where we have highly probable forecast future transactions, we use cash flow hedges. But where we have a firm commitment, we can apply a fair value hedge. Let me give you an example. We signed the contract to purchase the aircraft from Boeing in America. Now, if we were functioning in sterling, again, we would be concerned about the sterling dollar exchange rate. And let's imagine that over the year of constructing the aircraft, the exchange rate has moved. So when we signed the contract, we believed the aircraft was going to cost us 50 million sterling. But because of movements in the exchange rate, the aircraft is now going to cost us 60 million sterling. And thus, the cost of that firm commitment has actually increased by 10 million. Now, because it's legally binding, what we're actually allowed to do is we're actually allowed to create a firm commitment asset or liability. Here we would have a firm commitment liability since the cost of the aircraft has gone up by 10 million. Now the point is that we probably hold a derivative to hedge against movements in exchange rates, and once again that derivative would be measured at fair value through profit and loss. So by creating a firm commitment asset or firm commitment liability and remeasuring the fair value of that firm commitment asset or liability on an annual basis, we can see the movements on that firm commitment asset or liability would be taken straight to the profit and loss account. Once again, we see that the movement on the derivative would offset against the movements on the firm commitment asset or liability, and thus we have achieved hedge accounting. So that's our second example of fair value hedge accounting. There's one minor example to look at next, and that's net investment in foreign operations. And this would be a situation where we are having a foreign investment and we are financing it with a foreign loan. Now, under IAS 21, if you were to have a foreign loan, that foreign loan would have to be measured to year-end closing rates each year, and exchange gains and losses would have to go through the profit and loss account. However, if that loan is being used to finance a foreign investment, it could be that fair value movements on the investment won't actually hit the profit and loss account until you sell the investment. So if you can prove that you are using that loan to finance that investment, then rather than put the exchange gains or losses on the loan through the profit and loss account each year, you can actually put them into a hedging reserve. And by putting the gains and losses on the foreign loan into a hedging reserve, it means that they are not hitting the profit and loss account now. When you sell the investment in the future and the fair value movement on the investment hits the profit and loss account, that's when we release the fair value movement on the loan and release it into the income statement. Now finally, we'll just say a few words about impairment. And IFRS 9 has a proactive approach to impairment rather than a reactive approach. Now, what does that actually mean? Well, the old standard, IAS 39, was very reactive. In other words, we actually had to wait for there to be objective evidence of impairment before we could put through an impairment loss. Let's imagine I loaned you money at an effective interest rate of 10%. I'm contractually entitled to receive 10% from you each year. So initial investment of 100,000, 10% each year, and then the principal back at the end of the term gives us our effective rate of 10%. Now, under the old standard, I would have recognized finance income at that rate of 10%, but in the year of default, I would have recognized a huge impairment loss. Now that's what we call a reactive system. We wait for the impairment to occur. We wait for the objective evidence of impairment to occur before we're putting the loss through the accounts. Now IFRS 9 moves against this and actually has a proactive system of impairment. So although we might be legally entitled to receive 10% per annum, IFRS 9 has us anticipate how much we will actually think we will receive. Now this is very much a case of professional judgment, and it could be that I make an investment of 100,000, I think I'm going to receive the contractual amount of 10,000 in the first year, but then I'm predicting economic downturn in years 2, 3 and 4, and thus rather than receiving the 10,000 to which I'm entitled, I think I'm only going to receive 7,000, 7,000 and 5,000. Now, what we would do under IFRS 9 then is to recalculate the effective interest rate, and taking those anticipations into consideration, you can see that the effective interest rate comes down to 7%. So although we're contractually entitled to receive 10%, what we will do is we will use an effective rate of 7% throughout the life of the instrument, and thus it smooths out the effect of any impairment that might arise. Now each year we have to reassess what we believe the future cash flows will be, so that 7% figure might move each year depending on our expectations of the future. But the idea is that it does smooth out the effect of any impairment and thus gives better financial reporting. Now, how do we guess the future? Well, it is very much professional judgment. You often hear the phrase historic loss rate referred to though, and we can use the past as a way of actually anticipating the future. And a company might, for example, have a historic loss rate of 3%. Well, we could apply that 3% to future cash flows. But rather than just apply the historic rate, we will think about whether we need to modify it for any information that we actually have now and any information that we actually have about the future. So historically we might have used a 3% rate, but if we believe the future is going to be worse than the past, then maybe we'll use a 3.2% as an example. Now the question is, once we've calculated that historic loss rate, what cash flows do we apply it to? Well, the first model that we start off with is called a 12-month model. And in a 12-month model, there has not been a significant deterioration in credit rating of the original investment. And that means that the risk that we were willing to accept at the start has not really changed, and there's not really much risk of anything going too wrong. In which case then, we need only apply this historic loss rate to cash flows over the next 12-month period. However, since initial recognition, if there has been a significant deterioration in credit rating, then there is a much higher risk of things actually going wrong. So rather than applying that historic loss rate to cash flows over the next 12-month period, we will apply that historic loss rate to cash flows over the lifetime of the model, which of course would result in a much bigger impairment. Now, there is no strict definition of what is meant by significant deterioration in credit rating, and different organisations may interpret this differently. And therefore this really is a matter of professional judgment, and whether or not you use a 12-month model or a lifetime model is something which is going to be open to a lot of scrutiny because of the amount of professional judgment that goes into it, and because of the difference that is created in the amount of impairment under a 12-month model and the amount of impairment under a lifetime model. So I hope you find that all useful. As we say, this is just a presentation to give you an overview of the key points of financial instruments and perhaps a way of thinking around the situations you come across in questions. Do practice lots of questions on financial instruments, because the more you practice, the more familiar you become with the information they give you, the terminology they use. But use this overview as a way of interpreting that information in the question and the data in the question, and thus knowing how to approach the question. Many thanks.